So the biggest question in the world right now for NIO shareholders is, will NIO Stock get delisted from the New York Stock Exchange? There is a lot of different sources giving conflicting information, but the truth may well shock most investors. In just the past 2 weeks, NIO Stock has dropped more than 25%, and the reasons for this are quite simple. The question is whether this downward trend will continue, or is this stock a buy right now? So in this video today, I will discuss what is happening, why NIO has been dropping, and if this is the bottom or not. Remember, NIO is now at the lowest point in the past 6 months, and I will look at what professional Wall Street analysts think of the current situation. If you've been watching my channel over the past few months, you will have seen the huge gains that we have been making even while stocks have been dropping. So what are you waiting for? Hit that subscribe button now and stop missing out on this money making information. Turn on notifications and find out about these stocks as soon as I make a video, instead of finding my videos after the stocks have made gains. It costs you nothing, but it could make you a lot of money. This is not financial advice, and I encourage everyone to do your own due diligence whether investing in this or any other stocks. Now let's dive into it. So it all starts with this. DD's delisting could spell the end for Chinese stocks on Wall Street. The era of big Chinese companies heading to the United States to raise money may have just come to an end. DD announced Friday that it would immediately start the process of delisting from the New York Stock Exchange and pivot to Hong Kong. This all began shortly after its $4.4 billion IPO in June. Chinese regulators banned DD from app stores in China, saying it broke data privacy laws and posed cybersecurity risks. DD's repatriation looks likely to be the start of a trend, and the market should expect others to follow. Investors in such stocks have been on the edge for months. The S&P and BNY China Select ADR Index, which tracks the top US listed Chinese firms, has plunged 40% so far this year. Two developments this week further underscore the fact that financial ties between the United States and China are fraying. On Thursday, the US SEC finalized rules that would allow it to delist foreign firms that refuse to open their books to the country's regulators. China has for years rejected US audits of its firms, citing national security concerns, and Beijing is set to ban the loophole that allowed companies like Alibaba and Didi to list in New York in the first place. Today's companies, especially established market leaders or those in certain tech sectors, will likely face increasing pressure to list on China-controlled exchanges. Any price for this stock is too high a price to pay. NIO's ADR could be severely impacted if the CCP begins to urge Chinese companies to drop their abroad stock listings. In Q3, NIO's electric vehicle deliveries increased, but the risk is not worth the potential benefit. The CCP is pressuring Chinese enterprises to leave foreign exchanges and discourages them from registering ADR shares on foreign exchanges. A delisting would be a major setback for electric vehicle investors in the United States. Unlike Alibaba, JD or Didi, NIO and its peers in the electric vehicle industry have escaped greater scrutiny and regulation. The CCP is said to put more pressure on Chinese companies that are deemed to be too patriotic. Didi falls under this category. Chinese authorities ordered Didi's app to be removed from the Chinese App Store. The official reason given was that Didi had violated data laws. Didi's data collection practices were deemed illegal. The move on Didi is a bad omen for other companies with ADR shares. NIO is just one of many companies that could be affected by the CCP's long-term goal of making foreign stock listings of Chinese companies illegal. In the event of a delisting announcement, NIO's ADR shares are likely to drop significantly as investors try to liquidate their holdings. The key point to grasp here is that Chinese companies themselves request that their ADR shares be delisted and trading be halted in order to appease the CCP. This is not a result of enforcement actions taken by US regulators. The ADR risk is a significant risk that raises fundamental questions, such as how certain are you as an investor in an electric vehicle company that you actually own a stake in? Unfortunately, there is no certainty in the answer. The CCP could arrive at any time of the week and declare that the time for Chinese companies to use ADR is over. What happens next? In conclusion, The author doesn't know whether the CCP will pull the rug out from under him or not, and can you be sure that you actually own and trade what you think you own? In the case of NIO and other Chinese companies with ADR listing in the United States, the answer is no. That is why any price for NIO is too high to pay. Now, this is not the first time that this risk of delisting has been thrown around regarding Chinese companies listed on US exchanges. As retail investors, we seem to have very short memories, or maybe it is the fact that the majority of retail investors in general tends to change every year. Some might not remember that we've seen this before. In early 2021, the same story was being spread, except it was the US, not China, that was going to delist these companies. And how many of 2021's investors were even investing back in 2019, where we had a similar story? There was reports that these companies would be delisted, so this is nothing new. And this is why I like the next Seeking Alpha article. It at least acknowledges that the risk has always been there. So what about delisting risk? The risk has always been there, even without DD. Therefore, it's not like it's something new for investors to consider. Moreover, readers should be aware that DD is working on its delisting plans while pursuing a listing in Hong Kong. DD earned Beijing's ire because it did not receive approval for its listing, and it reported that the Chinese regulators are not working on a plan to delist all its companies from US exchanges. The Ministry of Commerce are formulating new policies to regulate how the variable interest entity, a VIE structure, can be used. Overseas listings through VIE structures will not be completely banned, and companies will be regulated differently based on which sector they come under. Therefore, it's unlikely that regulators will adopt a blanket approach towards all Chinese companies. In any case, a delisting is also unlikely to be the end of the world. The ADSs are entirely fungible if these companies seek a listing in Hong Kong. Therefore, what investors might have to deal with in the short term could just be a temporary headwinds and price weakness. But such challenges could also provide great opportunities to add more exposure. DD plans to sell shares in Hong Kong and delist in the US, reduces the risk of messy, forced delisting by regulators in both China and the US, and may signal that Chinese authorities' crackdown on it has peaked. The company's statement bolsters our view that Hong Kong IPO will come before a US delisting, with a seamless conversion of ADS into the Hong Kong listed shares. So the ultimate question becomes, is NIO stock a buy? Personally, I think that NIO is undervalued. The author of this article thinks that it's undervalued, and so do Wall Street analysts, which I will look at in just a moment. NIO operates in one of China's most important industries. Beijing wants its leading NEV players to grow bigger and dominate the world. In September, China's Minister for Industry and Information Technology emphasized that looking forward, EV companies should grow bigger and stronger. There is too many EV firms on the market right now. The firms are mostly small and scattered. The role of the market should be fully utilised, and we encourage merger and restructuring efforts in the EV sector to further increase market concentration. That does not sound like the words of a man intent on destroying an industry. And finally, I have this article from Thursday evening, which is a very good read. Morgan Stanley pounds the table on NIO stock. The stock market is often noted to be forward-looking beast, and look ahead is exactly what investors should do when considering the case for NIO, says Morgan Stanley's Tim Tsao. It's time to turn the page. A superior ecosystem, broadening customer, and distinct branding make the setup unique and favourable for NIO to gather strength in 2022. On November 29th, the ET7 model successfully rolled off the assembly line. Although doubts linger that the model's market entrance could be delayed, it's noted that successful pre-production gives NIO a 3-month lead time to ramp up output and prepare manufacturing necessities. Getting the ET7 to market on time could also calm investor nerves regarding the launch of the ET5 scheduled for mid-2022. A company needs other distinguishing features, and here Zhao counts NIO's broader range of capabilities beyond the cars. These include software, services, and energy solutions. Over the past year, the company has continued to grow its service network The pace of deployment has accelerated from around 200 battery swap stations at the end of 2020 to 300 by July and 600 at present. NIO stands to benefit from its robust user ecosystem and its strong brand, with NIO being up there alongside names such as Tesla and BMW. According to the development history of the Chinese auto industry, and particularly for luxury brands such as Mercedes and BMW, branding could be a key advantage for automakers to expand their product spectrum. To conclude this, while the share price has dropped so much lately, it would have been easy for this analyst to lower his price target or issue a hold rating, but he has actually raised his price target to $66 and given NIO a buy rating. Let's not forget that in the EV industry, the only company that has sales and production that competes with NIO is Tesla. So just for a quick comparison, NIO is considered to be the Tesla of China. NIO is now valued at only $51 billion, while Tesla is valued at 20 times this at just over 1 trillion. So guys, that brings us to the end of the video. If you've watched all the way through, then please hit that like button. It really helps the channel out a lot. What do you think will happen next? Do you think that China will call for the US delisting of all Chinese firms from US stock exchanges, or do you think that DD being delisted is an isolated incident? And if so, what do you think the future holds for companies like NIO? If you're new, subscribe and hit the bell notification, follow me on Twitter, and I'll catch you in the next one.